So the crisis in 2007. Now, probably as everybody knows, the crisis in 2007 was basically brought about because of problems with some subprime house loans in the United States. Now, subprime house loans are an interesting thing in themselves. Basically, subprime mortgages are mortgages given to people who probably have great difficulty in making the repayments. So these mortgages are very risky. Now, there was lots of reasons why this sort of lending happened. One of the reasons it happened is because the way the banking system changed, as I'll speak about in a moment. The reason that the risk wasn't seen as overwhelmingly bad was the notion that house prices, property prices were increasing. So even if people defaulted on their mortgages, the values of the property would have increased by the time they default, and therefore the bank or the loan company, the building society, would be able to recover their loan from selling the property. Now, the other significant thing about the crisis in 2007, which has never happened before, is that this crash caused very quickly a worldwide recession in economic activity. This is indeed the first time this has happened with such a speed. In economic history, in the history of markets, we have another example of a great crash, the great sort of stock market crash in the United States in the 1920s and 30s, the Wall Street crash. But that indeed did cause a worldwide recession, but it caused it over a period of practically 15 years. The crisis in 2007 caused problems in almost all market economies within months. That's a significant different problem here, that the interconnectivity of market activity in 2007 was far greater than it was in the 1920s and 30s when the previous crash happened. Now we now go back to try and explain why the subprime lending caused such a problem. If we look at this diagram, by the way, this diagram is taken from a BBC website. The link is on the information site on problem 4. If we look at the traditional model here, basically it involves the home buyer and the bank, or the home buyer and the building society. The home buyer applied for a loan, the bank assessed the home buyer's sort of ability to repay and so on, and the loan was either issued or not issued, and then the repayments went to the bank. So let's say the bank loaned somebody £100,000 for 30 years and a mortgage of 30 years. Then the repayments were spread over 30 years and the bank gradually got its money back. In the subprime model, the model that the model that all lending institutions, as far as I'm aware, changed to after deregulation, the sequence was considerably more complicated. We now had a mortgage loan market, a market where mortgages were effectively sold on to other institutions. The bank did not hold on to the mortgage for the length of time that the mortgage ran. The bank almost acts as an intermediary, just passing on mortgages from the home buyer to another institution. So the bank was not in the position of getting small amounts of money over, say, a long period of 30 years as the mortgage was paid back. What now happened was the bank sold the mortgage on the markets and immediately got the money for the mortgage back from the markets. Oh, we seem to have a problem here. Okay, next. Right, if I look at this next slide, I mean, this is just sort of reinforcing the notion of traditional mortgages. This is what happened in the UK before end of 1980s. The traditional mortgages were a long-term loan issued by the bank. The loan was secured on depositor assets. I mean, the way banking or indeed building societies in the old days worked was that people saved in them. You know, you put your income in them. You didn't use it all immediately. That gave the bank a certain amount of money which it could loan out to other people. And traditionally, they used a lot of that for long-term loans, even though the savings were quite short-term. It is the case that banks work on a notion that not everybody who puts their money in the bank is going to come along immediately and demand the money out. If they did, the bank would collapse. I mean, that was one of the problems that the Northern Bank was faced with in 2007, that that the people saving in the bank lost trust in the bank and they wanted to get their money out. The bank could not find the money to repay people in that case. Now, the traditional mortgage again was secured in the physical asset. So, for example, I applied for a mortgage in the bank investigated me, checked out I had reasonable income, blah, blah, blah. I seemed to have a reasonable job and was a trustworthy person. And they gave me a mortgage, but that mortgage was secured in a physical asset, my house. Okay. And the way they assessed the risk was indeed to look at what sort of income I was making, what sort of job prospects I had, and so on. For example, in the traditional model, being a lecturer in university was quite a good thing because you were deemed to be quite a good risk, and building society and banks would generally tend to assume that you were good for the money and that you could make the repayments and so on. Now that changed after Big Bang. But Big Bang, what we had was this notion of securitization. Securitization is basically taking the ability to get income in the future and sell that on, almost like a share. The notion that you can make money back from it immediately. So what happened after 1989, indeed slightly earlier in the United States, is bundles of dissimilar mortgages were sold on the wholesale money markets. A bank would sell a bundle of 1,000 mortgages with various risk attached. They were bundled up into an SIV, a securitized investment vehicle. Now, they were sold in the money market, the wholesale money markets. So the bank got money back from those. That money from the wholesale money markets would be recycled into further mortgages and loans. Now, that second thing is one of the drivers for the fact that we got subprime mortgages, and particularly in the United States. The reason was that the banks had to keep turning over the money. They had to find effectively more and more people to loan money to. This is something that simply didn't happen in the old model because the bank was just getting a small amount of income every month, perhaps from selling the mortgages directly. But once they were sold on the wholesale money markets, the funds immediately came back into the bank. The bank now needed, because that was their business. The banks don't make any money unless they can basically loan the money out again. So they needed to loan the money out again, and that was the impetus behind selling mortgages, almost forcing mortgages on people who had less and less security. Now, there's a mathematical argument. I mean, if you looked at, by the way, if you looked at the statistical videos that are on the front page of the information website, you will see in part of that they're talking about terribly sophisticated mathematical formulas which actually effectively decreased the risk here. And that was the argument here, that you were slicing up risky mortgages, putting them with other mortgages that were less risky. You're bundling them together in this securitized investment vehicle. The risk of default from that SIV was much less than the risk of default on an individual mortgage. So therefore, the argument was that the risk decreased. And indeed, as the satirical video says, that is a very complicated mathematical argument behind that to do with probability and so on. And the argument then was you further decrease the risk by dispersing the SIVs through many rounds of sale and resell and so on. One of the ways, by the way, this bit is quite confusing. One of the things I suggested, you look at the Professor John Kay's videos, he explains this in terms of reinsurance and reinsurance of reinsurance and so on, which sort of makes it somewhat clearer. But essentially the argument is that okay, I'm a bank, I sell £10 million of SIVs, which are lots of mortgages cut up in various ways. I sell that to another bank. They repackage this, they rebundle this, they sell it on. So part of my initial tranche of mortgages is sold on to a third party, some of it sold on to a fourth party, and so on. So the mathematical argument is that the risk goes down with each of these rounds. And of course, what is happening now is what I've already said, is that more funds are now available for house loans because the money is flowing back into the bank immediately. So example, if I went back to my original argument, let's say I got £1,000, sorry, £100,000, £1,000 rather ridiculous, £100,000 to buy a house in the bank. In the old scheme of things, the bank wouldn't get all that money back for best part of 30 years. Once they can sell those mortgages on the wholesale money markets, they get effectively most of the value of that mortgage. I mean, there is a discount because they have to leave some profit for the others, but they get most of that money back, including the interest I would pay over 30 years, back immediately. They now need to reloan that money to somebody else. That indeed is why more funds are available, and that is why, as time went on from the 1990s, riskier people were taking on and offered mortgages, because basically this machine has to keep turning over. The volume of loans has to keep increasing for this thing to keep working. And hopefully you can see, if you've looked at the first video, what's happening here is that the volume of trading is increasing, the prices keep going up, institutions, perhaps individuals, are buying and selling these things. They're buying them for a low price, selling them for a high price. Therefore, everybody's making a profit, and as long as this wheel keeps turning, it works. Everybody keeps making a profit. So this diagram roughly illustrates what happens here. Now, the reason I've put this diagram on the slide is for one particular reason. Is I've already explained that one, starting out with a mortgage, we then get an SIV with, say, 10,000 mortgages bundled into that. That's rebundled and rebundled and rebundled. Now, the reason I put this diagram up here, and the reason I want to explain what's happening here, is that after multiple rebundlings, the underlying assets become unidentifiable. When the first bank gave me £100,000 to buy a house, of course they knew what the assets that £100,000 was secured on was the building I was going to buy. However, by the time this is sliced and diced and gone around this circle 20 times, whoever's holding the SIV number 20 really has no idea what's in there. They know in principle that all bits of this SIV are secured on physical assets somewhere, but they have no idea what those physical assets are. Again, if it's going back to John Kay's videos on the website, he explained that what happened in Lloyd's of London, the insurance people's case, was when the Torrey Canyon disaster happened, I think in the 1970s. Lots of people involved in Lloyd's, were then called the names, suddenly discovered they were holding parts of these insurance policies. They had absolutely no idea that they had insured this oil platform. And that's the same problem with SIVs based on mortgages. By the time it goes through the cycle 10, 20 times, the institutions holding the SIVs have very little idea what assets are in there. Basically, the whole thing depends on trust. And this, of course, is something where what happened when the problems with subprime mortgages became apparent. Trust completely disappeared in the wholesale money markets, and so basically the whole thing ground to a complete halt very, very quickly.